Money, it's everywhere. It's the rent or mortgage payment, it's the groceries, it's the gas in your car and the clothes on your back. We trade our time for money. But how many of us really understand how money works? The truth is, most of us are taught very little about personal finance. We're thrown into the deep end, expected to figure it out as we go. This lack of financial education can have serious consequences. It can lead to debt, stress, and missed opportunities. But here's the good news. It doesn't have to be this way. Financial literacy is like a superpower. Once you understand the rules of the game, you can start making money work for you instead of the other way around. This book is your guide to mastering the money game. We'll cover everything from budgeting and saving to investing and debt management. By the time you finish reading, you'll have the knowledge and tools you need to take control of your finances and build a brighter future. Think about it. We learn math in school, we learn science and history. But when it comes to something as important as money, many of us are left in the dark. We're taught to work for money, but not how to make money work for us. This lack of financial education starts early. How many of us had parents who openly discussed money matters? How many of us learned about budgeting, saving, or investing in school? For many, the answer is probably not enough. The good news is, it's never too late to learn. Just like learning any new skill, mastering personal finance takes time and effort. But the rewards are well worth it. When you understand how money works, you gain a sense of control over your life. You're no longer at the mercy of your finances, you're in the driver's seat. In the coming chapters, we'll break down complex financial concepts into easy-to-understand language. We'll provide practical tips and strategies that you can start using today. Remember, financial literacy is a journey, not a destination. The first step to mastering any game is to acknowledge that you need to learn the rules. The same is true for personal finance. Many people avoid dealing with their finances because it feels overwhelming or even scary. But burying your head in the sand will only make the situation worse. The truth is, taking control of your finances is empowering. It allows you to make conscious choices about your money and your future. It gives you the freedom to pursue your dreams and live life on your own terms. This book will give you the tools and knowledge you need to become financially literate. We'll cover everything from creating a budget to understanding different investment options. We'll also discuss the importance of managing debt and building good credit. Remember, financial success is not about being rich, it's about having control over your money so you can live a life you love. Are you ready to take control? Let's get started. A budget. It's not the most exciting word, is it? It sounds restrictive, limiting. But the truth is, a budget is your roadmap to financial freedom. It's the tool that allows you to take control of your money and make it work for you. Think of a budget like a spending plan. It's a way to track your income and expenses so you can see where your money is going. Once you have a clear picture of your cash flow, you can start making informed decisions about how to spend, save, and invest your hard-earned money. The first step to creating a budget is to identify your income. This includes your salary, wages, bonuses, and any other sources of regular income. Next, list out all of your expenses. Be thorough, and don't forget to include things like groceries, transportation, entertainment, and those sneaky little subscription services that can add up over time. Now comes the fun part, sort of, analyzing your spending habits. Look at where your money is going and identify areas where you can cut back. Are you spending more than you realize on takeout coffee or restaurant meals? Could you be saving money on your monthly bills by negotiating a better rate? Section 2, tracking your cash flow. Now that you have a basic understanding of your income and expenses, it's time to start tracking your cash flow. This means keeping a record of every dollar that comes in and goes out. There are several ways to track your spending. You can use a simple notebook and pen, a spreadsheet on your computer, or one of the many budgeting apps available. The important thing is to find a method that works for you and stick with it. One popular budgeting method is the 50-30-20 rule. This approach suggests allocating 50% of your after-tax income to needs, 30% to wants, and 20% to savings and debt repayment. Needs include essential expenses like housing, food and transportation. Wants are non-essential items like entertainment, dining out, and hobbies. Tracking your cash flow can be an eye-opening experience. It's often surprising to see where our money actually goes, but knowledge is power. Once you have a handle on your spending habits, you can start making changes to align your spending with your financial goals. Section 3, cutting the fat. Let's face it, most of us could stand to cut back on our spending a bit, but that doesn't mean you have to live a life of deprivation. The key is to be strategic about where you cut back and to focus on areas where you won't feel the pinch as much. One easy way to save money is to reduce your monthly bills. Negotiate lower rates on your cable, internet, and cell phone bills. Consider switching to a cheaper car insurance provider. Look for ways to reduce your energy consumption at home. Another area where you can often find savings is in your discretionary spending. This includes things like entertainment, dining out, and shopping. Challenge yourself to eat out less often and cook more meals at home. Look for free or low-cost entertainment options in your community. And before you make a purchase, ask yourself if you really need it or if it's just a want. Section 4, budgeting with irregular income. Budgeting with a regular paycheck is one thing, but what if your income is irregular? Maybe you're a freelancer, a business owner, or you work a seasonal job. The good news is you can still create a budget and manage your money effectively. The key to budgeting with an irregular income is to create a realistic forecast of your earnings. Look back at your past income for the past several months or even years to get an idea of your average monthly income. If you know you have some lean months coming up, try to save a little extra during the busier times to help even out your cash flow. Another helpful strategy is to prioritize your expenses. Divide your expenses into two categories, essential and non-essential. Essential expenses are those that you absolutely need to cover each month, like housing, food, and utilities. Non-essential expenses are those that you can cut back on or eliminate altogether if necessary, like entertainment and dining out. Finally, don't be afraid to adjust your budget as needed. Life is unpredictable and your income may fluctuate from month to month. That's perfectly okay. The important thing is to have a plan in place and to be flexible enough to adjust your spending as needed. Saving money. It might not sound as glamorous as investing in the stock market or buying real estate, but it's the foundation of any solid financial plan. Saving allows you to build a financial cushion to weather unexpected storms and to take advantage of opportunities when they arise. One of the most important concepts to understand about saving is the power of compound growth. In simple terms, compound growth means earning interest on your interest. It's like a snowball effect. The longer you save, the more your money grows and the faster it grows. Let's say you invest $1,000 in an account that earns a 10% annual return. After the first year, you'll have earned $100 in interest, bringing your total to $1,100. But here's where the magic happens. In the second year, you're not just earning interest on your original $1,000. You're also earning interest on the $100 in interest you earned the year before. This might seem like small potatoes at first, but over time, the power of compound growth really kicks in. The earlier you start saving, the more time your money has to grow, and the more you'll benefit from the magic of compounding. Before you start thinking about investing or pursuing other financial goals, it's crucial to have a solid emergency fund in place. An emergency fund is a stash of cash that you can tap into in case of unexpected expenses, like a job loss, a medical emergency, or a major car repair. Having an emergency fund can mean the difference between weathering a financial storm and going into debt. It provides peace of mind, knowing that you have a financial cushion to fall back on if the unexpected happens. So, How much should you have in your emergency fund? A good rule of thumb is to have 3 to 6 months' worth of living expenses saved up. This means that if you lost your job or had another financial setback, you'd be able to cover your essential expenses for 3 to 6 months while you get back on your feet. Building an emergency fund takes time and discipline, but it's one of the most important things you can do for your financial well-being. Start by setting a savings goal and then create a plan to reach that goal. Even if you can only afford to save a small amount each month, every little bit helps. While it's important to have a long-term savings plan, it's also helpful to set short-term savings goals. Short-term goals are those that you can achieve in a relatively short period of time, typically within a year or two. Having short-term savings goals can help you stay motivated and on track with your overall financial plan. It's also a great way to reward yourself for your hard work and to enjoy the fruits of your savings. Some examples of short-term savings goals include saving for a down payment on a car, taking a vacation, making a major purchase, like a new appliance or piece of furniture, and paying off a credit card balance. When setting short-term savings goals, it's important to be realistic about your income and expenses. Don't set yourself up for failure by setting a goal that's simply not achievable, given your current financial situation. One of the best ways to make sure you're saving consistently is to automate the process. This means setting up a system where a certain amount of money is automatically transferred from your checking account to your savings account each month. Automating your savings takes the guesswork out of saving and helps you build good financial habits. It's like putting your savings on autopilot. You set it and forget it, and your money grows automatically over time. Most banks and credit unions offer automatic savings plans. You can usually set up a recurring transfer online or by contacting your bank directly. Some employers also offer direct deposit programs where you can have a portion of your paycheck automatically deposited into your savings account. Saving money is essential, but it's only the first step. To truly grow your wealth and achieve financial freedom, you need to put your money to work for you. This is where investing comes in. Think of it this way: your money is like a seed. If you keep it buried in a piggy bank, it will never grow. But if you plant that seed, your savings, in the fertile ground of the market, it has the potential to blossom into a mighty financial tree. Investing is simply the act of putting your money to work in assets that have the potential to increase in value over time. This could be anything from stocks and bonds to real estate and precious metals. The key is to choose investments that align with your financial goals, risk tolerance, and time horizon. Remember, investing is not just for the wealthy. You don't need a lot of money to get started. The most important thing is to start early. Be consistent and let the power of compound growth work its magic. The world of investing can seem complex and intimidating, but it doesn't have to be. Let's break down some of the most common investment options. Stocks. When you buy stock in a company, you're essentially buying a small piece of ownership in that company. Stock prices fluctuate based on a variety of factors, including company performance, industry trends, and overall market sentiment. Bonds. Bonds are essentially loans that you make to governments or corporations. In exchange for lending your money, you receive regular interest payments and the return of your principal at the end of the bond's term. Mutual funds and exchange-traded funds, ETFs. These investment vehicles pool money from many investors to invest in a diversified portfolio of stocks, bonds, or other assets. They offer a convenient way to achieve instant diversification and are a popular choice for beginner investors. Real estate investing in real estate can involve buying, holding, and selling properties for profit. This could be anything from residential homes to commercial buildings or even land. Precious metals, gold, silver, and other precious metals are often seen as a safe haven asset, meaning their value tends to hold up or even increase during times of economic uncertainty. These are just a few of the many investment options available. The best way to choose the right investments for you is to do your research. Seek advice from a qualified financial advisor and create a diversified portfolio that aligns with your financial goals. Section 3. Managing risk diversification and asset allocation. One of the most important principles of investing is managing risk. No investment is entirely risk-free, and even the most experienced investors can lose money. However, there are ways to mitigate risk and protect your hard-earned savings. Diversification is the practice of spreading your investments across different asset classes like stocks, bonds, real estate, and so on, as well as industries such as technology, healthcare, energy, and more, and even geographical regions. The idea behind diversification is that if one investment performs poorly, others may perform well, helping to cushion the blow. Asset allocation is closely related to diversification and involves deciding what percentage of your portfolio to allocate to different asset classes. The specific allocation will depend on your risk tolerance, time horizon, and financial goals. For example, a younger investor with a longer time horizon may choose to allocate a larger portion of their portfolio to stocks, which have the potential for higher returns but also come with greater volatility. Remember, diversification and asset allocation are not one-time events. They require ongoing monitoring and adjustments as your financial situation, risk tolerance, and market conditions change. Section 4. The long game, patience, and consistency in investing. Investing is a marathon, not a sprint. It's about making smart, informed decisions and sticking to your plan over the long term, even when the market gets bumpy. One of the biggest mistakes investors make is trying to time the market, that is, trying to buy low and sell high. The truth is, even the most seasoned professionals have a hard time predicting short-term market movements. Instead of trying to time the market, focus on time the market. The longer you stay invested, the more time your money has to grow and the more you'll benefit from the power of compound growth. Remember, investing is not about getting rich quick. It's about building wealth gradually and steadily over time. Be patient, stay disciplined, and don't let emotions dictate your investment decisions. The market will have its ups and downs, but by staying the course and sticking to your plan, you'll be well positioned to achieve your long-term financial goals. Section 1. Understanding debt, the good, the bad, and the ugly. Debt. It's a word that often carries negative connotations, conjuring up images of mounting bills, harassing phone calls, and financial stress. But the truth is, not all debt is created equal. Some debt can be a useful tool for building wealth, while other types of debt can quickly spiral out of control, jeopardizing your financial future. Let's start by distinguishing between good debt and bad debt. Good debt is generally considered to be debt that is used to invest in assets that will appreciate in value over time. This could include things like a mortgage on a home, as real estate is typically considered a good investment, since property values tend to rise over the long term, or a student loan, because investing in your education can lead to higher earning potential in the future. And even a business loan, as taking on debt to start or grow a business, can be a smart move if the business is successful. Bad debt, on the other hand, is debt that is used to purchase depreciating assets, things that lose value over time. This could include credit card debt, where using credit cards for everyday purchases and then carrying a balance can quickly lead to a mountain of high-interest debt. Or car loans, since cars are notorious for depreciating in value. As soon as you drive a new car off the lot, it loses a significant portion of its value. And payday loans, those short-term, high-interest loans that are designed to trap borrowers in a cycle of debt. The key to managing debt effectively is to understand the difference between good debt and bad debt and to make conscious choices about the types of debt you take on. Getting out of the red, strategies for debt repayment. If you're currently struggling with debt, know that you're not alone. Millions of people are facing similar challenges. The good news is there are proven strategies that can help you get out of debt and regain control of your finances. Here are a few popular approaches. The debt snowball method. This method involves listing out all of your debts from smallest to largest, regardless of interest rate. You then focus on making minimum payments on all of your debts, except the smallest one. You throw as much extra money as you can at the smallest debt until it's paid off. Once the smallest debt is eliminated, you take the money you were putting toward that debt and apply it to the next smallest debt, and so on. The idea behind this method is to create a sense of momentum and motivation as you see your debts disappear one by one, the debt avalanche method. This method prioritizes paying off debts with the highest interest rates first. You list out your debts from highest interest rate to lowest and then focus on making extra payments on the debt with the highest interest rate while making minimum payments on all other debts. The advantage of this approach is that you'll save more money on interest charges over the long run. Debt consolidation. If you have multiple debts with high interest rates, you may want to consider consolidating those debts into a single loan with a lower interest rate. This can simplify your finances and make it easier to manage your monthly payments. No matter which debt repayment strategy you choose, the most important thing is to be consistent and disciplined. Create a budget, track your progress, and celebrate your milestones along the way. Section 3. Credit cards. Friend or foe, credit cards can be a double-edged sword. Used responsibly, they can be a valuable tool for building credit, earning rewards, and managing your cash flow. However, used irresponsibly, they can quickly lead to a downward spiral of debt. Here's the key to using credit cards to your advantage. Treat your credit card like a debit card. Only charge what you can afford to pay in full when the bill arrives. Avoid the temptation to overspend just because you have a credit card. Pay your balance in full each month. This will help you avoid paying interest charges, which can quickly add up. Use your credit card for strategic purchases. Take advantage of rewards programs and cashback offers, but only if you were already planning to make those purchases. Monitor your credit card statements carefully. Check for any errors or fraudulent activity. Remember, credit card companies make money when you carry a balance and accrue interest charges. Your goal is to use credit cards to your advantage, not to let them use you. Section 4. Protecting your credit score, building a solid financial foundation. Your credit score is a numerical representation of your credit worthiness. It's a three-digit number that lenders use to assess your risk as a borrower. A higher credit score indicates to lenders that you're a lower-risk borrower, which can qualify you for lower interest rates and better loan terms. A lower credit score, on the other hand, can make it more difficult to get approved for loans, rent an apartment, or even secure certain jobs. Here are some key factors that affect your credit score. Payment history. This is the most important factor, accounting for about 35% of your credit score. Make all of your payments on time, every time. Credit utilization. This refers to the amount of credit you're using compared to your total available credit. Aim to keep your credit utilization below 30%. Length of credit history. A longer credit history is generally better. Types of credit. A mix of credit types, credit cards, installment loans, mortgages, can be beneficial for your credit score. New credit. Applying for too much new credit in a short period of time can hurt your credit score. Protecting your credit score is essential for maintaining a solid financial foundation. By practicing responsible credit habits and monitoring your credit report regularly, you can build and maintain a good credit score, which will open doors to financial opportunities and help you achieve your financial goals. Section 1. Your financial journey. We've covered a lot of ground in this book, from the importance of budgeting and saving to the ins and outs of investing and debt management. But remember, personal finance is not a one-size-fits-all endeavor. It's about finding what works best for you, your individual circumstances, and your financial goals. Think of this book as a roadmap. It's provided you with the directions, but you're the one holding the steering wheel. You get to decide where you want to go and how you're going to get there. There will be detours along the way, unexpected roadblocks, and maybe even a few wrong turns, but that's okay. The important thing is to keep learning, keep growing, and keep moving forward on your financial journey. Section 2. The power of financial literacy. Financial literacy is more than just understanding numbers. It's about understanding the value of your money, your time, and your future. It's about making informed decisions that empower you to live a life you love, free from the burden of financial stress. When you're financially literate, you're no longer intimidated by financial jargon or complex investment strategies. You understand the language of money and you're confident in your ability to manage your finances effectively. Remember, financial freedom is not a destination, it's a journey. There will always be more to learn, more to grow, and new challenges to overcome. But by embracing the principles of financial literacy, you're equipping yourself with the knowledge and tools you need to navigate the complexities of personal finance and achieve your financial dreams.